Hello everyone and welcome to your Glassnode video report for week 40, 2023. So what we're going to be looking at today is something a little bit different. We're going to do this session in two different parts. First, we're going to start with the Bitcoin assessment, as we generally do. And really what we're going to be looking at is, coin dormancy, what the long-term holder cohort's doing. Really, there is very little happening on chain. So what we're going to be looking at is a bit more in the unspent supply domain, really looking at what the long-term holders and the hodlers are doing. Because when there's not much happening, really they're kind of the cohort who's driving a lot of these things. So we'll explore that dynamic. And then we're going to shift gears actually and do a bit of a study on this concept of alt season. Now, the reason why we're going to look at this is capital rotation is a feature of all markets. We often see when we talk about the stock market, you'll talk about the breadth. At the moment, we're seeing the Magnificent Seven stocks basically absorbing all of the capital, and we're actually not seeing it trickle down to those lower levels. And in many ways, we see the exact same phenomena playing out in the digital asset space, where Bitcoin is essentially the Magnificent One, and everything else essentially gets the capital once the confidence returns to the market. So just exploring this and how more the capital rotates through the system and various metrics we can use to describe it. So as I mentioned, we're going to look at the liquidity profile with a focus on Bitcoin because essentially in this period of time where it is the Magnificent One, essentially that is where all the activity is really happening. There's just not much else happening elsewhere. And there's even Bitcoin is quiet and the rest of the networks even more so. And then we're going to focus on that alt cycle kind of liquidity, capital change, how money flows and changes. And we're going to use a really interesting dynamic we've touched on over recent weeks. So as always, please do give us a rate, a share, and a subscribe. Let me know if you have any comments at all, and let's get stuck right into the analysis. Okay, so we are going to start and actually use quite a bit here, the realized cap. Now, the reason why we look at the realized cap is essentially it is a foundational tool where so many metrics, concepts, and really a lot of the value that we look at when it comes to on-chain analytics, it comes from this idea of realized profit, realized loss, and ultimately when you take a sum of all the realized profit and all the realized loss, you get the realized cap. So for those who aren't familiar, what is the realized cap? We do have a video that explores specifically this metric, and this particular tool is actually developed as part of that. The realized cap is the on-chain equivalent of the market cap. Rather than looking at every single coin in the supply, all 19.5 million times the current spot price, which is really not a fair assessment because some of those coins are lost, some of those coins are long dormant, some of them traded yesterday. A better way to think about it in terms of the capital invested in Bitcoin is actually the price when they last transacted, because that implies that the coin is both not lost because it last transacted or unlikely to be lost. It's more mobile. It's been kind of saved. If you withdrew a coin at $10,000 in the previous cycle and you still hold it, it's saved at that $10,000 price point. So the realized cap captures the amount invested in the network. When somebody buys a coin low and sells it high, it gets revalued higher. When someone buys high and sells low, it gets revalued lower. And it's really representing that aggregate change in the invested capital. Now, what we're looking at here is the 30-day change. We often call it the net position change. It's just basically looking at the first derivative of our realized cap here in orange. Some general structure. Generally, we see these very sharp upticks in the realized cap, very positive capital inflows into Bitcoin. When we see capital outflows during bear markets, the realized cap will decline. These are coins bought at the top, being progressively revalued lower and lower and lower, and we see capital outflow. Now, what I want to do is just zoom in on really the last probably 5 or 6 years. Quite fascinating that 6 years, we're actually looking at previous cycle now. We must extend our zooms. Really, I want to look at our current cycle. Note how we had a bit of a burst of inflow. Let me just turn off our tooltip for this session. You can see here that we had a bit of a burst of capital inflow, but that really capped out towards the back end of July, and it's been very stagnant ever since. This is really describing the fact that there are just simply not many coins moving on chain at all. We'll talk about this in a bit more detail shortly. There's not many coins moving, and the coins that are moving are not really locking in a significant profit or a loss. It very much describes a bit of a jostling, like the coins are just kind of moving around within recent price history. We're not seeing coins from like the 60,000s moving. We're not seeing coins from 3,000 moving. Most of the coins that are transacting are from our current zone, very much in that short-term holder type cohort. Now we've just moved back to our week on chain dashboard here. And When you see that the realized cap is not growing, it's not really shifting a great deal, that speaks to a level of coin dormancy. Now, we can actually then see this in our long-term holder supply, which is pushed to yet another all-time high. I mean, this thing just continues to climb. 14.86. From memory, it's about 75% of the supply is now over 5 months. I mean, and what you can see is that this gradual grinding uptrend was typical of 2019, which, remember, was volatile and all over the place. It was typical of 2016, which was kind of a long sideways grinding pattern until the 2017 market took off. So in many ways, it looks like that bear market hangover into that kind of reconsolidation, reaccumulation phase that we have seen in previous cycles. But really what this tells us is a two-sided story. One, that the hodlers are hodling. And in many ways, that's a constructive sign. They're really, I mean, the world's in a pretty weird place right now, and the hodlers just seem unshaken and unfazed. But it also tells us that there's not much going on. So it kind of speaks to that the hodlers are there, they've got high conviction, but there's no one else coming to their rescue. They're pretty much the only people left. So that's the dynamic we're looking at. And if we look at the HODLer net position change, this is actually based on coin time economics, even though this metric did come out first and was part of the inspiration for that work. We can basically see about 52,000 BTC per month are moving into what we now call vaulted supply. These are coins that if we measure it based on the amount of time that they're accumulating, it's really telling us that the market is very dormant. Coins are preferring to be vaulted, hodled, put into long-term storage. These things tend to take time. That's the really challenging thing. What we've seen in previous cycles is this is the part of the bear market that is the most painful. It's the long, slow, boring, sideways grind where just nothing happens. It's a very stark difference to the bull market and even the savagery of a bear market when at least something is happening. This boredom happens in all markets. We just happen to be able to measure and see it in a really unique light when it comes to on-chain data. Okay, so putting all this into a bit of context, we've kind of theorized, we've looked at the supply and said, look, it's getting older and the hodlers are vaulting coins. But if we actually look at it on the amount of volume transacted per entity, we are pretty much back down to 2020 levels, right? We are back down to 2019. We've actually highlighted areas that have quieter on-chain volume. There's just not much volume moving around on-chain. The average transacted volume is about 12.5 grand in terms of value. Now, by the way, averages for Bitcoin, because it has positive skewness, the average or the mean transaction volume is typically in that kind of $12,000 realm, as you can literally see here. When we look at medians, there's a lot more $100 transactions, $200 transactions. The median, and they're actually affected by inscriptions, which we covered the other week. So, but anyway, on the mean, we are pretty much seeing a very, very light. I mean, it looks like that 29 period. Even though we are technically, the average price through here was about 8 to 10 grand through 2019. You know, we're not quite 3 times as high, but we're seeing a very similar amount of volume. So it really does show how quiet things are. If we look at our hot supply, this is a really interesting metric. So when we talk about hot supply, I mean, so what we call these things is somewhat arbitrary, but when we talk about hot supply, we're generally talking about coins younger than 1 week. Sometimes we extend it to 1 month, depending on the thing, but we're talking about coins that recently transacted. Now, what we've got here is the long-term mean minus 1 standard deviation. What we're looking for is really quiet times. And once again, we see all of these zones highlighted. We've got the bear market all the way through to the end of 2016, or the start of 2016, sorry. We've got the 2018 bear right through 2019, right? This is that same level that we were just talking about before at the start of 2020. And we've got 2022 all the way through to where we currently are. So it is showing that the amount of transacted volume is extremely light. The chain is quiet. The coins simply aren't moving. We can see this across many metrics at this point in time. Really, really quiet times. Again, has a lot of similarities to this bear market hangover. And you could even argue bear market, right? Still in that really light, quiet, there's just not much happening type of regime. Now, look, there's a whole bunch of metrics we can look at to track this. What we've got here is an interesting and widening divergence between illiquid supply and what we've got with exchange balances. Now, when we talk about liquid supply, highly liquid supply, this is a Glassnode metric. So liquid supply and highly liquid supply, we look at all of the wallets and we use our clustering. So if we look at Binance, for example, or Coinbase, they're going to have a set of cold and hot wallets. But we know that they're Coinbase, that if they fall into our Coinbase or our Binance or whatever entity cluster it is, overall, all of their wallets, how much of their wallets are they spending versus holding? So a hodler will withdraw their coins and they sit there for a long time. That wallet has very, very little history of spending. That would be classified as illiquid. Coinbase or Binance, they transact all the time. They've got coins coming in, they've got coins going out. Even though they've got cold and hot wallets, coins are constantly on the move, and that entity, by and large, is actually deemed to be liquid or highly liquid. So there's a grading curve between these two, but what we're generally seeing here is this long-term decline in exchange balances. Now, this has got a whole lot of there's a lot of nuances around it, but the general story is that we are continuing to see coins flowing out of exchanges, whether for self-custody, whether going into some kind of multi-sig arrangement. Back in 2021, we were seeing a lot of it going into GBTC. But what we're seeing is that these coins are generally going into what we would call an illiquid wallet. What that means is that they're not going into some other exchange's liquid wallet. So it does look like there is this gradual pulling off of coins going into HODLer wallets or investor wallets, which are generally deemed to be illiquid. And simultaneously, we're seeing them then age into the long-term holder supply. So it tells a bit of a story over that 5-month window. Before coins reach long-term holder status, they probably start out as illiquid. There's no probability on the spend with this metric, but it's no longer inside a liquid cluster as we look at it from that perspective. So let's think about this in terms of a time duration. We're essentially seeing coins through the 2022 bear market, and this is a period of time that aligns with those really quiet periods on chain. Remember, the only people who survive bear markets are people who believe in the asset. This is the same for any asset. You don't buy gold at the bottom of a bear market unless you really do believe in gold and why it exists. Exact same logic for Bitcoin. So what we're seeing is that coins are coming off exchanges. They appear to be going into illiquid wallets, which is less likely to be an exchange. And then if we just jump back up here, we start seeing those coins maturing 5 months later into long-term holder supply at a rate of about 52,000 per month. So overall, this is telling a story of the hodlers being in control. If we look at it in terms of the amount of volume flowing in and out of exchanges, we like to look at these momentum charts, 30-day versus the 365-day. We had a burst of activity, but it's pretty flat. So the chain's really quiet. Coins are dormant. The hodlers are the active ones, but there really doesn't appear to be that much reinforcements coming in. So that just sets the scene, right? It really does feel like that hangover bear market phase where only the highest of conviction remain, but that also doesn't exactly put a whole lot of urgency into the situation, right? Bull markets are where you see a whole lot of excitement. The news is talking about it. New people are coming in. Your Uber driver's talking about the asset. We are some distance away from that. It really just does look like the higher conviction, which generally, in historical terms, means it goes pretty quiet at this time. Now I won't. I'll get into the alt season thing because I think that's probably a nice segue. The last thing I'll just touch on is realized profit and loss. Again, we looked at volume. We've looked at aging coins. The amount of profit or loss being locked in is also insignificant. So this is why the realized cap has gone dead quiet. And by the way, we also have parity between realized profit and realized loss. We haven't seen this since the 2020 period. Generally, again, it's very, very quiet during these pre-bull market, post-bear market, this transitional, whatever it is, right? It takes time for the market to digest the chaos that was 2022. You generally see a massive divergence of profit in a bull and a divergence of loss in a bear. Because we're at parity, again, it speaks to that hangover phase, where there's just most coins that are transacting came from the same price yesterday, right? It's just jostling around for that marginally better position. And quite often that is a precursor to more volatility. When you get this seller exhaustion, both profit takers and loss takers, it moves towards this kind of point where the market wants to go. The question is, where does it want to go to? Okay, so now we're going to transition and look at this concept of sector rotation. I think this is a really fascinating concept. And the reason why we're going to be talking about it now, because quite frankly, based on what we're looking at, we're obviously some distance away from anything that could be classified as an alt season. So why are we talking about it now? Well, it's important to have these tools and really to understand the mechanics of how these markets work, because it's all well and good to learn about these things during the hype and the excitement, but it's another thing to actually learn about these things and be prepared and know what you're looking for as the market starts to turn over. So we spent a bit of time talking about the realized cap, and the reason why we did that is it really does represent the net capital flow into these assets. Now, this is a very simple metric which we've looked at in the past. Orange is Bitcoin, blue is Ethereum, green is stablecoins. And again, there's a bit of assumption here, but let me just try and describe what this metric is showing. This is the 30-day net position change of the Bitcoin realized cap. And again, positive means capital inflows. Coins are being revalued from 10K to 20K. And that means that somebody else had to come in with that extra $10,000 to buy that coin. Negative outflows is the opposite. They bought at 50K, they're selling at 30K, someone got wiped out for 20K. Bitcoin and Ethereum, we can measure that realized cap. And because they're the two largest assets, generally speaking, capital flows into Bitcoin first, which you can see here. The 2021 bull market was very much a Bitcoin-led market. And only once Bitcoin had all-time high at 64,000 and finally pulled back, did we see capital rotation from the Magnificent One down to Ethereum. We then got that major sell-off, right? And this was kind of where the bear market started to set in. But we did have a second rally. We almost had a second bite of the cherry where you can see Bitcoin leads, Ethereum followed much sooner. This was really describing the market had to see the confidence come into the big asset, Bitcoin, before it started to rotate into Ethereum. It had a bit of a shakeout, but then on the second leg higher, the market really got pretty excited. Into Bitcoin, almost immediately into Ethereum. We started to get this capital waterfall, this rotation of capital. Now, we've also then got in green our total stablecoin flows. So when we're looking at the total supply of the biggest stablecoins, Tether, USDC, DAI, BUSD, just a collection of how much stablecoin supply is there. Stablecoins have become the quote currency on both centralized and decentralized exchanges. Many of the altcoins that we saw trading during the previous cycle had that USD as the preferred quote currency. We see that stablecoin trading flows are significant. It used to be Bitcoin as the base asset. It now tends to be more stablecoins. People prefer that USD basis. So this expansion in stablecoins is actually describing that next step in the waterfall. Capital goes from Bitcoin, where the confidence comes into the market, rotates into Ethereum, and historically that first rotation from number one to number two has typically then initiated the risk-on behavior. And you can see that in both waves. The risk-on behavior came third and lasts the latest. We often see this. Bitcoin, even in 2017, Bitcoin peaked in December 2017, Ethereum peaked in January, February 2018, and then all the alts had that one final push into March, and then we saw the full washout. We can essentially see the exact same thing. That altcoin speculation actually peaked right. This is right as Luna was buying all of their Bitcoin and the market was very excited, got to 45K, and within a handful of months, we were at 17. And this was a major washout across the entire industry. So it was kind of that late final push into altcoins. Bitcoin goes first, Ethereum goes second, and then the risk curve expands and often hyperextends well beyond the healthy trend. So with that as a bit of context, what we've done here is basically plotted the exact same thing, but what we're looking for is we're trying to set ourselves some rules. How do we define what alt season actually is? Well, the first rule we're going to set ourselves is we want all three of these. We want capital flows into Bitcoin to be positive, into Ethereum to be positive, and we want stablecoin supply to grow. And if we do that, we'll get this green bar hitting a level of 1. That's essentially, it will vary between +1 and -1, depending on how many of those are in the green. So that's our first rule. We want all three of these assets to be seeing positive inflows, because it's pretty hard to have a bull market and alt season when you're seeing capital outflows, especially across the whole industry. Now, the second set of rules that we're going to look at is we actually want to see that Ethereum is starting to push higher. And so the second derivative of the realized cap, not only is it positive in terms of the net inflows, we want to see Ethereum and stablecoins seeing a net growth. We want to see the trajectory of capital inflows being positive as well. So what we've done here in this particular chart, we've highlighted in orange what we're going to call risk on. And risk on simply aligns with all three of these are positive. We're seeing inflows into the industry, full stop. The red zone, however, is picking up when we've got that second derivative. Ethereum and stablecoins are not only positive, but growing in the amount of capital that's flowing in. There could also be other checks, right? Depending on how detailed we want to look at this. You could also look at periods where Bitcoin is seeing a decline, meaning you're seeing that actual capital rotation from Bitcoin into the other assets. But this overall flow of funds, this waterfall effect of capital going from the confidence in Bitcoin down into Ethereum and then flowing out further on the risk curve, Orange is giving us risk on behavior, and the red is then going to give us our real mania phase where we're seeing that uptick in growth for Ethereum and stablecoins. And what you can see is that really you get it typically at peaks, right? This is when the confidence has hit this level where Bitcoin has found the strength and that capital then starts to waterfall down. Now, quite often, this actually can provide a signal of not only opportunity, because obviously things are rallying at that point in time, but also an indicator for risk. Because when you start seeing Bitcoin flows slowing down and that mania is still going further out on the risk curve, historically speaking, that's actually been a signal of risk. So it's one of these things we can use on both sides of the equation. You can actually see at the exact moment that Luna started to blow up and they had to start unloading all of their Bitcoin, it was peak altcoin mania. So it's one of these almost interesting within the trend, but also a bit of a counter trend contrarian indicator to just try and spot when things are getting really, really frothy. Now, what we've got down the bottom here, just to kind of nail this point home, one of the indicators we've got from Swissblock is the altcoin cycle signal. So this is, again, something that's developed based on the price signals coming out of Bitcoin dominance. We do have a dashboard available for our professionals under the signals section of dashboards. But you can see here that the actual decay of the altcoin cycle aligns very, very closely with where we're getting this switch from mania into risk on, into maybe not so much risk on. So you can see that these dynamics actually play out where we get these peak manias as things start to deteriorate, right? It's that kind of contrarian indicator. And when we start seeing things cooling off, it's showing you that capital is actually rotating away from risk because things are starting to get pretty frothy. So anyway, hopefully that's kind of a useful assessment. It's very much the same as looking at breadth across any of these markets, but just a really novel approach using realized cap and the change or the first and second derivatives of realized cap to really understand how that waterfall effect happens as capital flows through the system. So thanks for tuning in for that session, folks. Hopefully you found that useful. Again, we're really looking at this from a fundamental perspective. This is what I love about the on-chain data side of the equation. You can see the capital rotation. You can see things flowing from one cycle to the next. And quite often you can start with a really, really simple premise. And the question is, how do you measure capital inflows? And in many ways, realized profit, realized loss, and the realized cap ultimately is a fantastic way to see what's going on. Now, generally speaking, Bitcoin and Ethereum have fairly high signal when it comes to these things because they are the two major assets. They're where most of the capital flows in and out of. As you get further out on the curve, it becomes a little bit harder to measure. Does the realized cap have as much signal when a lot of these coins are traded on DEXs or on centralized exchanges? But certainly for those big two, you can at the very least establish a framework. And then with stablecoins is that third piece that really describes kind of it's the quote pair for everything else. Demand for stablecoins tends to increase when the demand for speculation and risk on tends to increase. So combining those three gives you a really nice overall view of what's going on with the market at large. So hopefully that was useful. Let me know if you have any comments, and I will see you in the next one. Cheers.